Has to be a Hall of
Good
Fame.
morning, everyone. This is the Vermont House Committee on Commerce and Economic Development. It is Wednesday, April 26, 2023 at 9:02 in the morning. So we're going to begin our day with an introduction and walkthrough of S-135, which is an act relating to establishment of Vermont Saves. We do not have possession of the bill, and unless something comes up where we need to have it, I think this is more of a drive-by for us to understand it. And if we see anything that pertains to us that we may want to ask GovOps to make changes to, we will, but I think it's more. So we'll get a walkthrough from Legislative Council, and we'll also hear from State Treasurer Pichek and also from AARP. So Rebecca, if you'd like to join us and walk us through the bill. We generally ask you to share your screen if you can.
Oh, okay. I can.
Or one of those that away the screen and share it with everyone that's watching on YouTube as well.
Sure, I have the Zoom. Yes, I do. Share it. All right. You want to see that?
Yes.
Okay, great. Becky Wasserman, Legislative Counsel. So this is S-135, which is an act relating to the Vermont Saves program. Before I start, I just want to get a sense of how detailed you want me to go through the language.
I think just a walkthrough, and I think as we're going through, if committee members have any questions, we'll just ask questions right away.
Okay.
I don't work for you.
Yeah, that's fine. So this is establishing in section 1 of the bill a new chapter in Title 3 to create the Vermont Saves program. So there are a number of sections being established in this chapter related to establishing the administration of the program. Section 531 is creating the definitions that are relevant to the chapter. So I don't know if you want me to go through all of them or just maybe highlight a couple that are relevant.
I think it'd be good to just go through the whole thing.
Okay, great. So the first definition is the contribution level, which is the contribution rate that the participant contributes to an account. And maybe I'll just back up because I think the definitions might not make as much sense before I just give a very general overview of the program, which is establishing a program for Vermont employees who work at a company that does not already offer a retirement savings program to their employees. And so this is an requiring employers to automatically enroll their employees into the program, and it gives the employees the opportunity to opt out. So it's like a mandatory enrollment, but voluntary for the employee to stay in the program. So with that in mind, the definitions will make a little more sense. So the contribution level is a definition for the contribution rate that the participant, which is the employee, is contributing into their account. And it is set up as one of a few options, a percent of the participants' taxable wages, a dollar amount up to a maximum deductible amount for the participant's taxable year. And in absence of an affirmative election by the participant, 5% of the participant's taxable wages. And I'll just note when we get to that, that this the initial contribution rate that's required under the program is set at a 5% contribution rate, and the employee can opt out of that, choose to do a higher amount or a lower amount. A covered employee under the program, so who is captured by this program, is any individual who is 18 years or older who is employed by a covered employer and who has wages or other compensation that are allocable to the state during a calendar year. A covered employee may also include a part-time, seasonal, or temporary employee to the extent that this is permitted under rules adopted by the treasurer. And this is later on in the bill, this is one of the sort of decision points that the treasurer can adopt a rule on.
Becky, the 18-year-old floor, is that because of federal law?
I don't know the answer to that, but I can get back to you.
I'm just wondering, we've got a lot of 15, 16, 17-year-olds that are in the workforce, and it seems to me it'd be a great time for them to begin their retirement. But I don't know if there's, a federal requirement.
Right. I don't know if there's a requirement for opening a retirement account that is a minimum age, but I can look into that. Back to you.
Maybe Treasurer Pichette knows that answer as well. So you can ask him when he comes up.
So there are a few types of employees that are not covered. Those employees covered on the Federal Railway Labor Act. An employee of the federal government, the state or any other state, county or municipal corporation, or any of the states or any other state units or instrumentalities, or any employee on whose behalf an employer makes contributions to a Taft-Hartley multi-employer pension trust fund.
How does this work if an employee is part of a union or has some specific contract with that business? So
they're not an employee, they're just a contractor.
Or they are an employee and they have to specify
Collective bargaining.
either collective bargaining or not, right? Both.
So I think an initial question is whether the employer is offering a retirement plan. So is it?
That's an opt-out for sure, but
Just that employer would not be covered by this program if they are already offering that. So if that is part of their collective bargaining agreement, then that employer, it's not mandatory for that employer to participate.
and then there are also employees who are contracted. Every year they have a contract, but they're not part of collective bargaining. So I'm just curious how that.
So the definition of employee does say that a part-time, seasonal, or temporary employee can be covered as permitted by the treasurer. So that might be somebody is just like a temporary contractor for an employer, then that could potentially be covered. I think that depends on how the treasurer determines who is, considered an employer for the purposes of that rule. An employee.
Thank you, Mr. Chair. Inside Thomas joke over here. Just for the record, I'm not gonna live that one down now, so that was a bad idea yesterday. Anyway, I'm wondering for employers, is there a minimum standard for the kind of pension that some, or retirement plan that an employer is providing? Or is it anything counts and therefore they're not gonna be eligible for this Vermont State's program?
So it's the definition of employer is any, person or entity in the state. It can be a nonprofit or for-profit. And the language about the retirement plan is that they can't have, so I'm on the top of page 3, they can't within the current calendar year or 2 preceding calendar years be offering a specified tax favored retirement plan.
So does that get into the specifics of the kind of plan? Like what if it's, I'm going to really exaggerate, but if it's $100 or it's, I don't know, I don't even know if you could even for 401k, but I'm just imagining there might be some employers who try to find a loophole who would just say, I'm going to offer super basically non-existent retirement plan, but check that box and therefore not have to do this, have you sign up for this program.
I don't know the answer to how that is defined, but I can get back to you.
Okay.
So a covered employer does not include the federal government or any state, county, or municipal government. An employer that has not been in business during both the current calendar year and the preceding calendar year. Then there's just definitions of ERISA, the Internal Revenue Code, an IRA, which means a traditional IRA or a Roth IRA, and a participant means an individual who has an IRA under the program. There's a payroll deduction definition, which is speaking to an employer that has an arrangement that allows an employee to contribute to an IRA through a payroll deduction. The program is used to reference the Vermont Saves program. And, sorry, I was incorrect. There is actually a definition of the specified tax favored retirement plan. I will look into what all these mean though in answer to your question. Roth IRA is a Roth IRA account as just defined in the Internal Revenue Code. The specified tax favored retirement plan meets certain Internal Revenue Code requirements, which I can look into and get back to you on. And a traditional IRA is also defined under the Internal Revenue Code. Trust account is the trust in which the assets of the program are held, and there is an ability for the treasurer to contract out some of the administration of the program to a vendor. So vendor is defined here to include a federally regulated retirement plan sponsor that conducts business in the state, a company that conducts business in the state to provide ancillary services that includes technology, payroll, or record keeping services, as well as offering retirement plans or payroll deposit IRA arrangements using products of regulated retirement plan sponsors. And vendors do not mean individual registered representatives, brokers, financial planners, or agents. There is a fund that's established in Section 534, and that is defined here as the Vermont Retirement Security Fund, and that is used for the purpose of paying administrative costs and expenses of the program. And then wages are defined using as any compensation within the meaning of the Internal Revenue Code that an employee receives in any calendar year. So Section 532 is where the program is established. So it is a program administered by the State Treasurer's Office, and the stated purpose is increasing financial security for Vermonters by providing access to an IRA for Vermont employees of companies that do not currently offer a retirement savings plan. There is some language directing how the program should be designed, which is to facilitate portability of benefits through withdrawals, rollovers, and direct transfers from an IRA and achieve economies of scale and other efficiencies to minimize costs. So the program is in subdivision 1, allowing an employee to contribute to the program, and that can be done through a payroll deduction. And then in subdivision 2, it's sort of that mandatory requirement that the employer offer it to employees, and the choice is given to contribute by a payroll deduction. And then there's language on line 11 that there's, the opportunity to opt out. Subsection B sets the type of the IRA as a Roth IRA, but the treasurer is authorized to add an option for all participants to elect to contribute to a traditional IRA instead. Subsection C speaks to contributions. So this is where I mentioned this earlier. A covered employee automatically initially contributes the 5% of their salary or wages to the program. They can opt out at any time or contribute at a higher or lower rate. In subdivision 2, the treasurer will set an annual increase of the participant's contribution rate, and that will be not less than 1%, but not more than 8% of salary or wages each year. So that applies to active participants, including participants by default, and there's still that option to opt out of that increase. And there's also language here that says that the increase is subject to the IRA contribution and eligibility limits. And that is because there is a maximum contribution amount under the law every year for Roth IRA. Subdivision 3, the treasurer will provide for direct deposits of contributions. And subdivision 4 speaks to the fact that a covered employee is not required or permitted to make a contribution into the IRA under the program. And that is a legal issue about implicating ERISA laws if an employer is contributing into the account. The subdivision 5 says that each participant owns the contributions and all the earnings on the amount that's contributed to their account under the program. The state and the employers have no proprietary interest in those contributions or earnings. On page 8, the treasurer is directed to administer and implement the program. As I mentioned earlier, there is authority for the treasurer to contract with a vendor to administer the program and manage the investments in accordance with the chapter. So there are some guidelines for how the program should be administered. So first, the program should be designed in a manner that's consistent with federal law, and that's includes making sure that employers are not being subject to ERISA. The costs and expenses of implementing and administering the program can be paid or defrayed from investment returns or assets of the program or through fees or charges. And I'll get to that a little further on about what a set amount of a fee that the treasurer can charge. The treasurer is also asked to establish certain processes and requirements to administer the program. First, that has to do with the processes for enrollment and contributions to an IRA. including withholdings by covered employers of the payroll deductions from wages to deposit into the account. Processes for automatic enrollment in a payroll deduction IRA and opt-outs for covered employees. The making of default contributions using default investments and allowing a participant to select different contribution rates or amounts. There's processes for phasing in enrollment of eligible individuals, for allowing participants to make non-payroll contributions to accounts under the program. Processes for an employer to be determined to be exempt from the program because they already have a sponsored specified tax favored retirement plan. And requirements, as I mentioned earlier, on whether a part-time, seasonal, or temporary employee should be a covered employee that's eligible to participate in the program. Subsection E, the treasurer is required to maintain separate records and accounting for each account under the program. And there is language on line 19 that allows for participants to maintain their accounts regardless of their place of employment and to roll over the funds into other IRAs and other retirement accounts. So there's sort of a portability aspect to the employee's account. Subsection F requires the treasurer to send annual reports to each participant of the account detailing the status of that participant's account. Participants can also have access to online access to the information in their accounts. In subsection G, there are some sort of outreach and disclosures that the treasurer is required to do. So they have to make efforts to reach out to individuals, employers, and other stakeholders and the public regarding the program. And that includes the frequency, timing, means of required disclosures from the program to employees, participants, and other individuals that are eligible to participate.
That would be, say, notification to the employee when the next year comes around that your contribution rate will increase by 1% unless you decide to opt out of that increase.
Yeah, I think that under the disclosures, this would catch those sort of notifications about the increases, and so both to the employer and the employee. And I think this could also cover just notifying an employer that they're a covered employer under the terms of the program, so that they have to offer this to their employees just to make them aware that this program is in existence.
Sort of along those lines around the employer's effort for disclosing that this exists and needing to do outreach and whatnot. I'm curious if there's other language that's more specific around the employer's obligations to do so, especially if it's, I don't know, a new employer that forms 5 years from now or something. But also, because I've either been on both boards or other entities where the retirement basics are not shared in a very proactive way with new employees. There isn't a lot of not necessarily counseling, but there isn't a lot, just even orientation of this is our existing plan, and this would be yet another existing plan, especially if they don't really offer it, both on the front end of employment, throughout employment, but also when people depart. And that, I think that puts people in a very precarious situation to know what is portable, what is in terms of the end of employment, what are my options, that kind of stuff. So I'm just curious if that is anywhere in here around more specific to employers' obligations. So I think they're a critical partner in this. There's only so much the treasurer's office and the state can ever do to reach employees and know that this exists and that you're eligible. But then beyond that, there's some deeper stuff that, I'm just thinking of this board I was on. People didn't really know, and there wasn't that encouragement to say, in that case, there was even an employer match actually, and for various reasons, I'm not going to speak about this employer, but it was everyone was sort of just a little bit asleep at the wheel and not encouraging employees to actively even put a small amount in to start with. That whole concept of retirement is a good thing to be planning for.
I don't believe there's anything that specific to employers. There is a whole section on the treasurer's sort of duties and rulemaking requirements and about designing and administering the program. So I think that could be caught under that. There's also penalties involved if an employer does not participate or do so within the implementation time period. So I think that's another way of sort of letting employers know that this program exists, because there could be a penalty involved if they are not actively participating. But I don't believe there's anything specific about an employer needing to notify. So subsection H, participant accounts. So this section sets forth how the interest and earnings and losses shall be allocated to each participant's IRA, and what their benefit would be under the program, which is equal to the balance in their account as of any applicable measurement date that's prescribed by the program. Subsection I deals with program assets. So the treasurer is authorized to establish a trust account to hold the program's investments and assets that meet the requirements of the Internal Revenue Code. Any trust established under this chapter is considered an instrumentality of the state and not subject to ERISA. In subdivision 2, there's also language that clarifies that there's no assets of the program or the trust fund that's established. The retirement fund that's established can be transferred to the general fund or any other fund of the state, or used for any other purpose. And then subdivision 3 says that all contributions that are made to an IRA under the program can only be used to pay benefits to participants, the cost of administering the program, or make investments for the benefit of the program. In J, the treasurer is authorized to charge a fee to defray program costs. It's sort of discretionary for the treasurer to determine the amount and method of collection of that fee, but there's a maximum amount of $30 per participant in each calendar year. And yeah.
And maybe this is a question for the treasurer, but do you know why a number is set and not a percent for the fee? I always get uncomfortable when there's a number set in statute because it's not tied to anything.
I can let the treasurer's office speak to that, but I think it was tied to sort of a survey of other fees charged in other states with similar programs. And I think because the legislature is the one that under statute sets and authorizes fees each year, this is a way to authorize the treasurer to do it, but give some limit on the amount that they can charge without coming back to the legislature each year to change that amount if it needs to be changed.
And then just to kind of build on that, we have people who are contributing a percentage of their income, which may not be a big percentage, right? So a $30 fee could be unacceptable, I'll say it that clearly, for depending on how much somebody is contributing. So I think that just, I don't know, a couple of red flags are popping up.
Sure, and that, so that is.
I just wanted to flag that.
Yeah, so that's, something the legislature can decide to change that fee amount, or, require that the treasurer's office, come back to the legislature.
Not more than X percentage of the amount of money in the account or something like, I think that would be a safeguard that would be beneficial to the participants. or not more than X percentage of the contributions of the year or something that we.
I think that would be something that Ways and Means will be looking at. Heather?
Well, I was just going to say, or no fees if it's below X amount.
Yes. Right.
Because even a percentage of nothing is something.
Yep.
And in subdivision 2, under the fee subsection, an employer is not required to fund or be responsible for collecting fees from the participant. So section 533 sets forth the duties of the state treasurer. So the treasurer is authorized to adopt rules that are necessary for implementing and administering the program. And there are a number of kinds of rules that are listed here. So rules relating to the distribution of funds from the program and promoting portability of benefits. And so that includes things like tax fee rollovers or transfers from IRAs under the program to another IRA. Rules on a participant's initial contributions up to a specified amount or for a specified period of time are required to be invested in a principal preservation investment or must be defaulted into such investment unless the participant affirmatively opts for a different investment. The treasurer is authorized to enter into contracts or agreements with other governmental entities to establish that maintain or are establishing retirement savings programs compatible with this program. And the treasurer's office might speak to some of those arrangements that would be part of this. But so it would allow them to work with another state that has a similar type of program in place.
Be similar to the ABLE program that. Be similar to the ABLE program that Treasurer's Office now runs.
I'm not familiar with that one, but so the treasurer is authorized to enter into sole source or simplified bid process in order to do that. They can also contract with a financial institution, trustee, record keeper, investment managers or advisors, or any other sort of administrative or professional experts to offering or servicing retirement programs. The treasurer will establish criteria and guidelines to offer qualified retirement investment choices. They will also cause the program and accounts established under the program to be designed and established with best practices for retirement savings accounts and avoid preemption of federal law. The treasurer can apply for and accept grants or other gifts, appropriations, or loans, or any other state funds to defray program costs. The treasurer will also be looking at whether it's necessary to procure insurance against any loss associated with the property or assets or activities of the program. The program will require the treasurer to enter into an agreement with the Department of Taxes to facilitate checking program eligibility for employers and employees, and to share tax return information to verify wages to determine whether an individual is covered by the program. The treasurer can also enter into an agreement to receive outreach, technical assistance, enforcement, or compliance services, or any other collection or dissemination of information that's relevant to the program that is subject to, confidentiality restrictions under the law. And the treasurer is required to discharge the duties as a fiduciary with respect to the program. So the the interest solely within the interest of the participants. So that's outlined as the exclusive purpose of providing benefits to participants and defraying reasonable expenses of administering the program with the care, skill, prudence, and diligence under the circumstances then prevailing that a prudent person acting in a like or capacity and familiar with those matters would use in the conduct of such a program that this is, aiming to establish.
Yeah.
So section 535 is establishing the Vermont Retirement Security Fund that's administered by the treasurer. What goes into the fund is any money appropriated by the General Assembly or any transfers into the fund, as well as any money from payment of fees, penalties, and other payments due to the program. The fund can also include any gifts, grants, or donations to the fund. The treasurer will credit all interest and income derived from the deposit and investment of monies in the fund. And the unexpended and unencumbered money will remain in the fund at the end of the fiscal year. So in section 535, I referenced that there were penalties for employers who failed to enroll their employee without reasonable cause. So that employer is subject to a penalty for each employee for each calendar year or portion of a calendar year during which the covered employee was not enrolled in the program or had not opted out of participating in the program. And there is a schedule for the amount of the penalty that's imposed on the employer for the failure to enroll an employee. Prior to October 1st of 2025, the maximum penalty per covered employee is $10. Between October 1st, 2025 and ending September 30th, 2026, that penalty increases to $20. And then after October 1st, 2026, it is $75. The maximum penalty is $75. The treasurer is authorized to establish a rule that waives that penalty for a covered employer. So there's some limitation to that the waiver provided that no penalty shall be imposed on any failure for which it is established that the employer did not know that the failure existed and exercised reasonable diligence to meet the requirements of this subsection. No penalty shall be imposed on any failure if the employer exercised reasonable diligence to meet those requirements and complied with all the requirements with respect to each covered employee by the end of a 90-day period, beginning on the first day that they knew or should have known that the failure existed. And then finally, if there is a failure that is due to reasonable cause and not to willful neglect, the treasurer is also authorized to waive all or part of the penalty to the extent that it would be excessive or otherwise inequitable relative to the failure that is involved. Section 536 protects both the employer and the state from liability. So covered employer is not considered a fiduciary with respect to the program. In subdivision 2, the covered employer is not liable or shall not bear responsibility for an employee's decision to participate in or opt out of the program, any of the participants' investment decisions, how the program is administered, and the investment returns or performance of the program. The employer is not liable for the program design or the benefits that are paid to the participant. An individual's awareness of or compliance with the conditions and other provisions of the tax laws that apply to the IRA, including what amount and in what time frame and manner, or any loss or failure to realize any gain, including any adverse tax consequences that are associated or incurred by a person participating in the program. And with respect to the state, the treasurer and the program have no responsibility for compliance by individuals with the conditions and provisions of the Internal Revenue Code that determine who's eligible to make contributions to an IRA. They have no duty or responsibility for any party for the payment of benefits under the program. The treasurer can't guarantee any interest rate or other rate of return or investment performance for any contribution or account balance, and the treasurer is not liable for any losses that are incurred by a person that is participating in the program. Under Section 537, confidentiality, the treasurer will establish policies and procedures that are consistent with the Vermont Public Records Act and other statutory provisions for the program participants' personal and confidential information. Section 538 requires the treasurer to submit an annual report to the governor and the legislature on or before January 15th each year, starting in 2024. So that will go to this committee and the Government Operations and Military Affairs Committee in the House, and in the Senate, the Senate Economic Development and GovOps committees. And that will include details on the activities, operations, receipts, and expenditures of the program during the preceding calendar year, and any other information regarding the program. The report will also include the number of participants, the investment options, rates of return, and the projected activities of the program for the current calendar year. So Section 2 is an implementation schedule for the program. So this is subject to an appropriation from the General Assembly, and right now there is an appropriation in the big bill for FY24. The program will be established under this timeline. So beginning July 1st, 2025, all covered employers with 25 or more covered employees shall offer the program to all covered employees. And the following year, 2026, employers with 15 to 24 covered employees have to offer the program to their employees. And then in July of 2026, the requirement is on employers with 5 to 14 covered employees. Section 3 of the bill is a repeal section, and this is repealing the Green Mountain Secure Retirement Plan that was.
Okay, excuse me. So under 5, there's no obligation. Under 5 employees, there's no obligation to.
The law does not specify under 5. But an employer could still.
To volunteer.
Could participate, yes.
What happens if there's a participant and a covered employer, they change jobs and they go to an uncovered employer? Is there a requirement for that uncovered employer to continue to?
So if the employer would not meet the definition of an employer under the program, there's no requirement, but there's portability of the account. So the employee could move that account to, roll it over into another IRA that is not under the program. They wouldn't lose their retirement account.
Isn't the purpose of this to prevent that very thing from happening already?
Well, if they are, let's say if somebody is working for an employer that's covered, but then they take a job with the state and the state is not a covered employer under this program, this would not be forcing the state to offer the program because the employer, in this case, the state already offers a retirement.
They're exempt.
The state is exempt from this.
Yeah, but there's other employers that have less than 5 FTEs. And so if someone were to go to them and there wouldn't be a requirement for them to withhold. And the hope is that because those people have been taken it out. I think this is more of a discussion we need to have with the treasurer.
Right, so this does not specify that an under employer with under 5 employees has to enroll an employee by a certain date.
It might be something. We'll have a discussion.
Not now, thanks.
So Section 3 is repealing the Green Mountain Secure Retirement Plan, which was enacted in 2017, and this program would be essentially sort of taking the place of that program, which didn't really move forward. And then Section 4 is the effective date, so this would take effect on July 1st, 2023.
Sorry, Becky, this is all for-profit and nonprofit employees. Employee doesn't differentiate that way.
The definition of employer includes both for-profit and nonprofit.
And just, again, going back, and a self-employed person could opt to participate in this or not?
Yes, I mean, if someone is just self-employed, they could just open an IRA anyway.
Is there a benefit to that is the question, right?
I think maybe that's a question for the treasurer's office. I don't know if there's any specific benefit to a person who's self-employed opening their own account versus going through the program.
Actually, you can do more under SEP IRA, just from personal experience as a self-employed person. But it's a good question, I think, to talk more with the treasurer if we're going to do this effort of launching this out to make sure self-employed people also know what options are out there. Because I stumbled upon it myself. It would be good to just be holistic around all the different ways that Vermonters are working these days, which include a lot of folks who are really dabbling or moving squarely into self-employment. So that's a shout out to my accountant that I remember that, and I.
Any other questions for that?
Thank you.
Thanks.
Good morning, everybody. How are you?
Good. Thanks for joining us this morning.
Yeah, of course, my pleasure. Thanks for having us. So Becky did a great job of the walkthrough, so I might not go through my full presentation, but might start with some of the questions I know that heard here, just to make sure there's some additional information. So to Representative Granning's question about the employer and the employee relationship. So, this is intentionally not an employer benefit. It's something that sort of exists outside of that sort of employer-employee benefit. So if there were a collective bargaining agreement, I think, it'd be sort of like collective bargaining over, Social Security or something, sort of separate, from that relationship. And I think many, as Becky pointed out, many employers would, if they do have a unionized workforce, likely would have retirement that would exempt them from this program. Not always, but, I think that would likely be the case. So I think that's sort of our perspective on that issue. On the invading the 401k question, I think probably the most likely two programs that a small business would have would be a 401k or a simple IRA. And under both of those, there are requirements for the business, both from an administrative cost perspective and even from a contribution perspective for their employees. So it wouldn't, there are in other states examples of employers deciding to go into those programs when this kind of program gets established because they want to provide a more robust benefit. But it would be a really expensive and complicated way for them to try to evade this program, particularly when there's no cost. So that hasn't been the experience in the other states, fortunately. It's been, if anything, increasing the amount of retirement that's available to their employees by going to one of these plans. And to the chair's question about 18 years or younger, you can set up an IRA or Roth IRA at any age. But I believe when they're under 18 years old, they have to be parental or custodian accounts, which would complicate things in this employer relationship. So this is how the other states have done it, is cut off that 18. We could look at it in the future and see, what other states' experiences are, but that would, I think, be the complication.
I just think.
Yeah, I agree with you. The
younger you can get somebody started on a retirement plan, the more robust it'll be when they do.
Absolutely right. So that's something we certainly can look into to try to figure out how to incentivize that or how to work around those challenges.
Treasurer, just to go back to that piece around employers, so both with the unionized workplace as well as just an employer in general, so I'll flip it, so not the people who want to make it as cheap as possible to get through, but nothing precludes an employer from doing better or improving upon, whatever.
Yeah, absolutely right.
is offered in this particular program, or a union for bargaining a better.
Oh, for sure.
A better piece, even if if they are employed by an employer who is eligible for this program.
Yeah, exactly right.
When there's issues that get into employment, there are sometimes exemptions for places that have collective bargaining agreements in place. But as long as there's an ability for the union to do better.
Oh, absolutely.
That's a good thing. At the same time, it is a question because some, unions are a legal entity to be able to kind of bargain the conditions that they have. And sometimes there might be other trades, frankly, to be based on the democratic process of those members in that collective bargaining agreement to decide they're going to prioritize X over Y in their bargaining process. So it is a piece I think I'm still going to think about, but as long as people can improve upon it and there's something that precludes that, I think that's.
Yeah, no, I mean, that's totally right. I mean, our goal is to provide, retirement access, and the more robust that, the access will be there hopefully for everybody under this, but the more robust the contribution amounts are, the more robust the employer participation is, all the better.
So IRAs and 401ks all have rules, right?
Yes.
And if an employer has a program, but an employee's not eligible because sometimes I think there's 1,000 hours of work. Vermonters have a lot of part-time jobs. That employer, could they offer this to those employees? No.
Well, if, I think the question would come down to whether they're required to, or could they voluntarily? It's something I think we'd have to look at in the rulemaking. If they had a covered plan otherwise, they would not be one of these covered entities.
But you're leaving out some employees that don't have enough don't have access to it even though it's offered.
Right. So that's one of the areas I think in rulemaking we'll want to consider and see what flexibility we have on that.
Okay.
We'll have our own requirements as to part-time and full-time and hours and such, but but that we want to, like I said, we want to try to get as many people covered and access as possible. So.
Okay. Well, and some of those 401ks just don't allow for people to save. So it would be great if employers who did offer something but didn't have employees that were eligible could offer this.
Yeah. Yeah. We'll look into that for sure.
Okay, thank you.
I think as this continues to evolve, that those things could be considered going forward. I think it's important to get it going and then.
Yeah, for sure.
See how much more we could do here.
Thank you, Mr. Chair. So I'm just trying to wrap my head around the program a little bit. I apologize, a little behind schedule today. So in terms of the way this program is operated, is it mandatory or voluntary for businesses to participate in this program?
So businesses that don't offer a retirement program, they would be required to sign up for the program. No cost to the business, but they'd be required to sign up. And then the employee has the default to be in the program, but can opt out of the program.
Okay, and in terms of the program, when the businesses sign up, they're not obligated to pay a match into that program, correct?
Yeah, that's correct. They actually can't pay a match because we're intentionally designing it to evade's the wrong word, but to be outside of the ERISA regime to reduce the cost and make it more efficient.
Okay, that makes sense. Is that the big thing for me? I'm just trying to clarify, especially for the folks that may be watching that are a little bit lost in the language and whatnot. Just clarifying that it's not going to present any additional financial burden to businesses.
Yeah, no, exactly right. I mean, that was a big thing for us too. I mean, one of the things that we like about the program is that it becomes self-sufficient, that there's no ongoing taxpayer money that's required. There's no cost from businesses that are required to operate it. I can mention the fee question in a minute, but the fees that come out of the investment accounts generally in the other states are lower than what you would have in a 401k plan that a business would run because there's just less oversight and requirements. But that's what funds the program in the long run. And we do have in our slide deck just a page that talks about sign-up process in some of the other states. And we went through it in the state of Connecticut as the treasurer's office. We wanted to see what that was like. And it was a very well-done, efficient, thank you, up on this, program. They ask very simple questions, information about your company, information about how often you do payroll, how you pay your payroll, and then who your employees are. So in the state of Colorado, they discussed that when they worked with companies in the pilot program and then worked with helping onboard companies, that they didn't see anyone that took more than 15 minutes on the initial sign up, and they report back that it's just minutes per subsequent payroll period. So it's a pretty low administrative burden, because even though there's not a cost, we were also concerned what's the administrative burden, and it seems to be quite limited. So the benefit, in my opinion, greatly outweighs that, slight administrative increase.
Okay, so essentially, just to kind of put the program in synopsis, businesses are required to sign up for it, but they do not have to pay into it. They just have to make sure people that have the option. So folks invest in this IRA, and the state acts on their behalf as the investor to put into this program so that way people have that retirement money for that specific account.
Yeah. Yeah. And the only thing I would just clarify on that is that we as the state are not the fiduciary, employers not the fiduciary. We will, it says that we can operate the program or hire vendors. There are vendors in this space that at this point are very well experienced. So that would be the option, would be to hire the vendors that are in this space. And so there's generally a vendor that interacts with the employer that sets up the Roth IRA. And then there's a vendor that provides the actual investments themselves. So that would be like, State Street or Fidelity or a very sophisticated financial firm. So they would be providing specific investments within the accounts. It wouldn't be the treasurer's office coming up with them. And the custodian of the accounts, in the example of Connecticut, there's a vendor, and then they use a Bank of New York Mellon as their custodian for the accounts. So they would be the custodian of the money. And then another financial firm would be offering the investment. So very professionally done, entities with great expertise. It's not something that, it's not that we wouldn't have that expertise, but they have experience not just running this program, but generally in matters of investing in retirement savings.
Okay, so to understand the chain of command, so the employer pays into the program, money goes to the state takes the money, manages administrative costs, other outstanding costs, reimburses the third party that's handling the financial transactions, and then once the money's reinvested, then when they retire, then they're able to withdraw from this account.
Yeah, and just the state never will get the money. It will go from the employer right to the IRA. That's the custodian in this example, Bank of New York Mellon. So it goes from the employer to the custodian of the account. So it doesn't go through the state, but the state would get its fee from the accounts themselves. So Bank of New York Mellon, on a quarterly basis, depending on how it's set up for the percentage fee, or on an annual basis for the straightforward, no more than $30 fee, would remit that to the state. So the state doesn't have control of the money at any particular point. And then the other point, it's a Roth IRA. So it's post-tax. So any amount of money that an individual contributes to the Roth IRA, they can pull out that principal without penalty or tax. They can't pull out the investment earnings. Those have to stay in subject to the requirements. So just wanted to make that point, that if you have an emergency, something dramatic happens, you need money, this program sort of functions as a default emergency savings account, although it's primarily for retirement. So you can get your money at retirement like you would with the other retirement plan, or you can pull out the principal under any circumstance. But, if something happens that you need money.
And folks are allowed to have multiple retirement accounts even if they participate in this program?
Yeah, exactly right. The only thing they have to be mindful of is the limits for each specific account on an annual basis. So you can't have two IRAs or two 401ks and double your annual contribution amount. So there's one annual contribution amount for those types of retirement plans.
Thank you, Mr. Chair.
Thanks, Mike. I'm just curious about the outreach portion. I'm curious. One, I don't recall how much is appropriated in the budget for this effort, if you could remind me. And two, do you think that you have enough staff, and is the funding level sufficient to conduct that outreach? Can you partner with any other group? I'm thinking public or private. I'm thinking the much desired Vermont Business Portal, amongst others. are there private nonprofits that you can work with? I mean, reaching every business would be 500 accepting those groups, but.
Yeah, for sure. So thanks for that question. So, the appropriation amount is $750,000. So that would get us between, basically July of 2023 and sometime into July of 2025 when there would be money in these accounts and they would build up over time. And our idea is to hire 2 people. I think the appropriation is for 3, but we know 2 would be, in my opinion, necessary. 1 would be a director of the program. The other would be an outreach coordinator that would work with businesses and employees too, and businesses for their employees to make sure that they're aware of it. The other sort of mechanical thing that happens here, and the way that they set it up in Connecticut, is that when we work with the tax department, as was mentioned, they'll give us they'll give our vendor, all of the different businesses that at that time qualify for the program. Each one of those businesses will have an account set up for them. They will take out the businesses that from the federal tax filing, they can determine have a 401k, so they would be exempt. And then they'll send out notices to all the other businesses, either by email or by mail if we don't have an email for them. And they would have a unique code that would say, here's Vermont Saves. It would explain it, go and take control of your account. They would sign up with their unique code, put this information in, be signed up. Their employees also, once their employee information is put in, would get what they call a day 1 communication that would say your employer just signed you up for, Vermont Saves. That would be done either by email or by mail, depending on the type of contact the employer has provided for the employee. They'd be given like a day 30 communication that would say, your opt-in period has run out. This is what's going to happen with your funds. So there's that built-in structural notice both to the employer and to the employee. But then I think there's opportunity to partner with other entities throughout the state. AARP, who's represented here, has been a big champion of this program for us over the years. And they, in the past, have expressed the desire not just to utilize their outreach tools, but actually potentially put financial resources to helping us do outreach as well. So that's one significant partner, and I'm sure there'll be others that we can identify too.
Awesome. Thank
Heather?
I heard, and maybe you said Roth, but I heard that you could have either Roth or plain.
Yeah, that did say our intention is to, to have a
Choice.
Roth, but go ahead, Gavin.
Deputy Treasurer Gavin Boyles for the record. There is a provision in the bill that would allow us to at least look at the potential to offer a traditional plan as well, but the initial plan and what other states have done is just the Roth. It's just simpler. So the thought, I
Right,
think,
but
is to
it would be good to
do
give
that first.
people as many choices that fit them. Just
Yeah, I think we wanted that flexibility for us to look at that issue, but the intent and the plan is to go forward with the Roth like
only.
the other states. Yeah, at least initially.
Okay.
Thank you. So I'm wondering, Mike, about back to that other question I asked when Becky was testifying around adding something more around the employer's obligation to help with some level of education, because that's where
Yes.
employees spend most of their time, obviously, and the state is so much further removed, despite having more staff to help you with just letting you know this exists. So I'm just curious your thoughts on adding some components that just up the level a little bit of that the employer has some obligation to at least say that this exists and offering some baseline,
Yeah.
counseling, I don't know what the right word is, but just advising that this is a program and it's a worthwhile one and whatnot.
So I think it's a great question because, we're going to be thinking about that too in terms of both rulemaking and outreach. Like, how do we partner with the businesses, not just to let the businesses know what, their benefits and responsibilities are, but then to filter that down to the employees. So there may be some structural rulemaking that we can build into that process. But I think the big benefit is going to be with our vendor. There's 2 vendors in this space and both of them have the ability, once the employer signs up, to communicate with the employees, regularly, particularly if it's by email, at almost no cost. So that option and that ability I think is going to be huge in terms of providing information about the program to all of the employees that are in the program. And it would be quite simple, I would think, for that vendor or even for the treasurer's office to provide a website that had more information and more detailed explanation about, what Vermont Saves is, sending a link to the website, sending a webinar. There's a whole host of things that we can do. And that's going to be that person's sole, occupation is going to be trying to figure out how to not just inform the employers about the benefits of this program, but to make sure employees are educated as to the benefit of not opting out. and keeping their money in the program as well, because they have that ability to pull it out if need be. So I think those are the two important education points, is the benefits of staying in the program and the benefits of keeping your money in the program long term.
And I imagine part of that would also be, the sort of the employee's cycle, right? So coming in and leaving in those points of transition.
Yeah, exactly right.
Know like what their options are. And I think less for the employer, of course, but for if you do have a good landing spot for people when they're searching, I hear about this program, but they're self-employed, just bringing that piece back in, it would be great to also, because
Yes.
I imagine the spirit of this is just to make sure that all Vermonters know what their options are, because
Absolutely.
it's easy basics that could be put out about self-employment, what those options, the standard options are for people to help find that. The other question I had in terms of the entity that the state would ultimately select to be to hold the IRAs, I guess, and are there, I know that in other spaces you've been talking a lot about just kind of more of a conscious set of values, if you will, around who the state decides to invest with and put dollars. This is another opportunity for a conscious decision to be made. And so I'm just wondering if you've had any thoughts so far around how to pick that company and anything you're looking for. I know IRAs, right, can't be like broken up in some sort of socially conscious kind of way, but you can still use a lens when selecting a company that's going to hold, in theory, a lot of money on behalf of Vermonters for this program. So I'm just curious what you've been thinking about so far around what you're looking for in a.
Yeah, I mean, so we'll have to do an RFP and see who replies to it, so I think that will be sort of an opportunity to compare them based on a whole variety of factors. But, the number one thing that we're thinking about is who has experience operating this program in another state. We want it to be done. We want the rollout to be as smooth as possible. We want the communication to be as effective as possible. And a couple of these vendors have good track records of doing so in other states. When it comes to the investment firm, I think that's another opportunity, because there'll be two vendors, that sort of upfront custodian type vendor, which is really much more operational. And then there's that sort of investment vendor, and then what kind of target funds are allowed to be in the investment vehicle. That's something to look at. So maybe there's an ESG related target fund. It probably would be more expensive than the others. So it's something that would have to be communicated to the investors, but at least trying to build an option like that is one way of considering, incorporating those kind of considerations, I should say.
So thank you. You answered it. You answered some of my questions already, and I appreciate the thoroughness that your answers, you're really thought this through. So one of my questions early on was who's going to administer the program, right? You talked about vendors. I understand that piece of it. I was trying to understand how the costs stay low as we have so many middle people involved, right? And so at some point I was like, oh, the state's gonna run the program. No, we're gonna have vendors. The vendors are gonna make it, part of a bigger, maybe it's gonna be less expensive because we're able to partner with other states. I'm curious what your thoughts are around that, around how we keep costs down for folks and allow their investments to continue to grow. So I know that's just a little bit more in depth than just how we set up a program.
Yeah, for sure. No, but it's a great question, because obviously, we want to provide access. We don't want to cannibalize investment with fees and costs. And so we do want to keep it low, and we'd like to keep it lower than even other options that are available as well. So again, one thing that gives us confidence is just the experience of the other states. They've been able to charge a pretty low, like a 3 or 4 basis point fee on the investments. And then they've added on this additional annual one-time fee, which we were talking about earlier. And that has proven to, sufficient to pay for their staff and to pay for the vendors as well. And I think maybe if we go thank you. If we go the one slide up, you'll just see sort of a projection of, the account balances that Vermonters would see, after year 1 up through year 10. And this is based on having similar uptake as other states have seen. So of the people that are eligible, about 73% of them participating. Of those who are participating, about $2,000 a year that they're putting away, and a 6% annual investment return. So those are all the assumptions here. And you can see the corpus of all of the funds collectively grow quite quickly and quite substantially. So I think that is what, gives us a lot of confidence that there'll be sufficient funds to keep the fees low and be able to pay for all of the costs. I think the fees could get even lower potentially if we're able to partner with another state. The state of Connecticut, I mentioned earlier, it's a regional partner that potentially, we could find a partnership with to bring the investment fees down, in particular, maybe the operational fees. The state of Rhode Island is considering a very similar program this year. So that there's a couple of New England states. Maine is another state. Oregon would be another partner. They've been at the forefront of this for 5 or 6 years. So there are a lot of options out there to get the overall cost very low. But the pool that we're going to be able to charge the fees from, we expect to be quite significant pretty quickly.
So in the law, it was talking about treasurer sending the reports annually to folks.
Yeah.
But maybe the language should be modified, the treasurer or designate, so that the vendor can just a technical.
Yeah, I think I think that's right. We would anticipate the vendor sending it. I mean, I think by saying the treasurer, I would
That was just a little.
say maybe it assumes all of our agents as well, but it would be our vendor that would be sending that out automatically, just like they would the other communications.
And then one more, that's it. Oh, go ahead.
To that point, though, I think that by specifying the treasurer, it leaves the responsibility with the treasurer. It leaves it local, not with another outside entity. So that responsibility still sits with the treasurer's office.
Or the treasurer shall ensure, or some, whatever. I just, writing a bill report that is all about technical changes makes me think about the way we're writing bills a little bit better, a little bit more. And then my last question is about the report back to the governor and to the, and I was just I wrote my notes but I wrote notes about the increase or decrease of the balance or the number of participants or things like that. I just feel like those are the pieces of information that are helpful. The balance could be growing and the number of participants could be decreasing. Right? And so we would want to have that information early on to understand, that something needs to be looked at.
Yeah, no, I think whatever it says in the language, we'd intend for it to be as much information and as transparent as it could be. And just one question on the $30 fees that we mentioned. So I was talking with Gavin, there is significant flexibility around those for the treasurer's office. Our intent is to, again, just be able to cover our costs, not to charge fees that cannibalize the investments that are in the accounts. Particularly, some people could stay in the program, but say they don't want to participate anything at the moment. So it could have a zero balance in their account. So we wouldn't want to charge them a $30 fee if there's nothing in their account. But similarly, if it's a percentage, when these accounts grow over time and hopefully there's tens or hundreds of thousands of dollars in them, a simple percentage could be a significant portion of somebody's account that we don't need that much money for. But I think the $30 fee was something that other states have implemented. It gives us flexibility to collect money to directly pay for our expenses in the treasurer's office. But our intent would be to protect those, on the downside and not take more than we need on the upside. So that will be played out in rulemaking, but that's our intention, just to clarify that, just to make that point clear.
Last question, I don't know if this is for you so who has oversight over your department? Does the legislature have oversight? Because this is something that I think we came back with, maybe with UI earlier this year, and if we don't have reporting or different ways of setting up, how do we ensure that the department is running at the most efficient level and not, over understaffed and not very different pieces like that? So what are the checks and balances there?
Yeah, so certainly the legislature, the Commerce Committee, the House General Operations and Military Affairs Committee on the Senate side, Economic Development or Finance, those are just like when we were at DFR, those are all of our committees of jurisdiction that conduct oversight. Obviously an independently elected position, so voters have opportunity to do that as well in terms of their votes. But certainly the legislature plays a role in that.
I'm wondering if there's language in the reporting back about the department and not just about the program, right? Maybe there's a piece there that it could be beefed up.
Yeah, and we do also an annual report about our department as well that goes into some of the operational components, of our full agency. So I think they complement each other, those reports, and certainly could include more information in this one.
Legislator questions.
Yeah.
Just trying to get my hand.
No, yeah, for sure. No, it's great.
And maybe to that point, I think they want to think about including appropriations, ways and means.
Yes, yeah.
Sides of the House and the Senate, because, we are appropriating dollars. I think appropriations is going to want to see those reports.
Yes.
Fees that, there is a fee there. I think Ways and Means would want to see that as well. So.
Yeah, I think that's a great point, Chair Marcotte.
So I'm a little concerned about not the self-employed individual, but the 2 to 5 micro enterprises. How do we capture them in this? They're not in the implementation section. I do wonder if we have data about in my own imagination, I would imagine that those corporations, those businesses that do not offer retirement plans are in fact, the majority of them are the small businesses, the 50 to 100 or more groups typically do, in my understanding. So how do we reach them? Can we include them in this bill at all?
So just to answer your first point about the data, if we go to slide 3, we don't have, it's not super granular, but it does, if you go down to employer size, I think it's just 2 more up. 1 more. There we go. So if you go down to employer size, you can see. Sorry. Thanks, Andrew. So you can see the number up in the top right, the 88,000. So this is an estimate about the number of Vermonters not covered, and other estimates have it about 100,000. So it's somewhere between this 88 and 100,000, but this breaks it down by, age, race, education, gender, employer size. So a couple of things, just overall overrepresented in this 88,000 are lower earning Vermonters, younger Vermonters who are less educated. They're more likely to be BIPOC, more likely to be female. So just in terms of the overall policy goal, like providing this opportunity for access to retirement will be really significant. But if you look at the employer size, you can see, the number of individuals that are, under 10 is a significant portion of the overall estimation of businesses. So under 5 would not be a minor group. The reason we set the statute the way that we did is that no other state at this time has implemented all the way down to 1 employee. Oregon is in the process of doing that now. So we'd like to see how that goes for them, both from a operational standpoint and from a small business standpoint. So we'll have more information on that in the next year or so. So we did want to provide that as an opportunity. We didn't want to prevent them from participating in the program. We just didn't want to require it without having the experience of some other state, having done it in the first instance. That's partly why we're so excited about this, is because the confidence that these 12 other states provide us in terms of passing and implementing the program. So we'll look into that certainly when Oregon passes and see what we can do. I think there's also an outreach to that employer group too, even though not required, to know that it is something that is a benefit for them at no cost to participate in. And we've heard from very small employers that said they want to sign up on day one, that they can sign up. So we want to make sure that message gets out.
Great. And I would imagine too that we would be the smallest state implementing such a program.
Yes, exactly right. Just to give you, Colorado has that same sort of implementation breakout. And I think they, in their first round, had like 120,000 plus employees. And maybe if we're fortunate, we'd have 70,000 or 65,000 participate. So just in their first phase, they had more than we'll likely have in the whole program.
Quick question, Mike. I was interested about the 5%, and I saw that Connecticut there's at 3%. And as an employer when I had staff, when we offered a Roth and a match to our employees, I was always surprised at people who wouldn't take us up on it, and that they were put in 3% and we would match the 3%, which seemed like a good thing, right? But I think some people are really worried about that amount of money being taken out of their paycheck and not being able to sustain this.
Yeah.
So I think 5% is a good number, but I worry that it's maybe feels too big to some people.
Yeah.
Because I know that even 3% felt too big to some.
So I think the first point on that is to know that, you know, an employee can go in, change that amount down or up at any time.
They can go less than 5%.
Yeah, they could put it, they could set it at 0 and they could say, I want to be in the program. I just don't want to contribute anything now, put it at 0.
Okay.
But but the default is 5%. So let's say they ignore the paper, and then all of a sudden they are getting the 5% taken out. That would be the default. But as I was mentioning, it's a Roth IRA. So 6 months in, they have $1,000 in the Roth IRA. They could say, you know what, I need that money to pay for X, Y, Z, and they could take it out without penalty or tax as long as it's the principal. So I think that is important, but the data also is useful from the other states. They have, 70 to 75% of employees will stay in the program. And then on a year over year basis, the number is it's like over 95% stay in year over year. So the data has shown that people are, even if they've made a mistake and they're saving for retirement, unintentionally, that inertia of saving, it sort of compounds and they stay with it. But there are those abilities to get out of the program, to have a lower amount, or to get your principal out of the account if you need it.
I mean, I remember having many conversations with people saying, so advising them and educating them, like, if you take that amount out, you're really never going to see the difference in your paycheck, or it will be such a small amount.
Right.
And in the end, after taxes, they'll be negligible. So
Yes.
It's just a great idea.
And one thing, to your point, you really want to, 5% and it ratchets up if it's a default up to 8% over time. I mean, that's a good amount, but 10%, 15% are often what people talk about, even 20% for savings. But another opportunity that everyone will have, but Vermonters will have in 2027 is a revised federal savers credit that will, for lower income earners, match up to $2,000 from the federal government into a qualified retirement account. So if you're making under $70,000 and it will phase out, and they haven't released the specifics, but let's just say you're making $50,000 and you're fully eligible for the match, and you're putting enough into a qualified retirement account to get the full $2,000, then every single year you're doing that, you'll get a $2,000 match from the federal government directly into your qualified retirement account. But it needs to be you can't just be saving it in your bank account. You can't just be saving it in your brokerage account. It needs to be in a qualified retirement account. And this would be, yeah. So another reason to do this generally and to do it now is to make sure as many Vermonters are covered by 2027 to take full advantage of that new federal savers credit that was recently implemented in December of 2022 by the federal government.
It's great.
Yeah, we're very excited about that component. And I'll just mention these projections that we had did not include the federal savers credit. This was just based on contribution amounts, so it could be even more significant.
Mike, I just wanted to make sure I heard you correctly. An employer who has less than 5 employees can opt to be in this program.
Yeah.
They're not required.
Exactly right.
Okay, great.
And we'll look into that in the future as Oregon. Yeah.
And having the Roth is great because the state gets the taxes now.
Yes,
But
right.
from the employee point of view and wanting to encourage savings, and Stephanie's point of 3% is hard for some people, that's why it would be really great, in my opinion, to be able to have an account that they could pay taxes on later and encourage savings now.
Yes.
If that's really what we want to do.
Yeah. One other way to think about that is, so if you look at the breakdown here by age, a lot of the folks that are not covered now are younger, younger employees. So to pay the tax now
Is a benefit.
if hopefully they're progressing in their
Hopefully, yeah.
career.
Or part-time or right. I get that.
So we'll want to look at both of those things.
Right.
Yeah.
But depending on the individual, it could make a big difference.
Yeah. And if we're able to provide that kind of choice, then with the same low expense, it's something we'll want to explore. Yeah.
Okay.
I think
That's a good point.
You need to understand as well as with the Roth, when you take that out, the interest that you've accumulated is not taxable.
Right.
So you're taking it out, you don't pay any taxes on anything you're taking out. So that's, huge benefit when you're retired too. But if you're at a point where, what your income is when you retire and you're not going to be taxed anyway, then you might want the benefit upfront.
Yeah, and I think that point, Chair Mark, is, particularly important if you end up becoming, moving up in tax brackets as you get older.
Hopefully.
Yeah, hopefully, yeah.
Question of, someone that signed up and then moves to a changes.
Oh, yeah.
And is working for someone that's exempt, outside is the, ones that are already providing 401k or the state or any instrumentality of governments. But, a business that has under 5 FTEs. It seems to me without a requirement there for that individual, for that business to then make sure that that individual is signed up, we may be losing people. And so I'm just wondering, what other states are doing, what your thoughts are of at least requiring any business that's falls in that category, that even though they're not participating, they have an individual that is participating, they need to sign that individual up.
Yeah, I think it's a good point, Chair Marcotte, and I think it's going to go into that sort of studying about going down to one altogether. So I think you'd probably want that business to participate for everybody if they're going to do it for one. And how it would mechanically work, under the draft as is, just like if the person moved out of Vermont to another state that didn't offer this, or went up to an employer that had a 401k or a pension, it would just become their Roth IRA.
It's there.
Yeah, they can contribute to it, just not through payroll deduction. Yeah. Now, the other good thing about the program is, as Becky mentioned, is portability. So if you go from one employer that's participating in Vermont Saves to another employer participating in Vermont Saves, you have your one profile as an employee with your one Roth IRA, and it will just port from one employer to the next employer. And if you're working for two employers at the same time that participate in Vermont Saves, you could say 0 contribution over here, 5% over here, 2 over here, 3 over here, or however you want to arrange it. So I think that, that's one of the positive sides in terms of that portability. In terms of folks moving to a non-covered employer, certainly requiring everyone down to one would take care of that issue. But we'll certainly look into other ways of making sure that employee continues to have access to the program other than requiring all small businesses to participate.
I think it's just much easier. This is going to be set up as, just an automatic withdrawal from someone's paycheck. Once you start it, you don't miss it.
Exactly right.
But once you move from one entity to another that's not participating, you're, I think, probably extremely less likely to continue to participate in the retirement program.
Exactly right.
Be able to seamlessly make that continue to happen, I think, is an advantage.
Yes.
Hi, so, sorry, I probably could dig through the bill and figure it out, but employer notification upon hire, is there an employer notification piece when the employee-employer relationship is severed so that they can continue? Is that part of this, or is that going to be rulemaking, or how does that, just to?
Yeah, I think through the vendor, at any of those moments, there'll be communication. Any of those important employee moments, there'll be communication. Yeah, even if it's not required, there'll be like information about when somebody's terminated. You can go into the system and terminate an employee from your payroll very simply, and that could trigger a notice by email or mail to the employee about their continued, and they would still be able to sign into their account, even if they're terminated. That's their account, their Roth IRA account.
And the vendor is incentivized to keep the employee, right, or the person as part of their program.
Yeah.
So that's, okay.
Plus it'd be us wanting them to do it would be another incentive. Yeah.
There are multiple incentives.
Yeah.
Sure.
So and this is just a hypothetical scenario. So let's say individual has a 401k or different retirement account, the different employer, and they decide to go to a new employer, still have their previous retirement account. would they have the flexibility of being able to roll over their previous retirement accounts into this program?
Yeah. You can roll, if it's a 401k, I know you could roll it over to IRA, but this would be a Roth IRA, so the tax treatment would be different.
Okay.
So I think there's that complication. So I think because of that, it would be a challenge. I don't think you'd be able to roll it into the Roth IRA unless things think I'm different. Yeah, okay. If we're an IRA, potentially something you could do. But it would, they just sort of sit parallel to each other.
Okay,
Yeah.
thank you.
Mike, how are you going to determine which businesses have 25 or more, then down to 15,
Right.
and down to 5? Where does that information sit?
So that we have to get that from the tax department.
Tax?
Yeah. And that's why as Becky did the walkthrough, that was sort of the partner that we identified, maybe the labor department too, but, and then you'd have to make that determination at a point in time, right? Because somebody could go from 4 employees to 6 employees so you'd have to pick a point in time and then redo that on an annual basis. Particularly for like
labor has, when you file your employment.
Exactly, yeah.
Your contribution, your quarterlies, that you're putting that information in, how they capture that, I don't know. Because some people are salaried, some, have hourly. I don't know that they're, I'll let you figure it out. Other questions for Mike? I think very exciting program. I think is going to benefit a lot of lower income Vermonters to get them started on the road to, retirement security that people don't have right now.
Yeah, I think that's right, Chair Marcotte. We refer to it as a program with a big impact without a big price tag because it will have a large impact for individual employees, but also long-term for the state of Vermont, hopefully as folks have more secure retirement, more discretionary income for the economy, but less dependence on state and federal benefits long-term as well.
Thank you.
Yeah, well, thank you all.
Thank you.
Greg, good morning.
Good morning, Chair Marcotte. Thanks for having me.
Coming in. We're anxious to hear AARP's perspective on this legislation.
Well, thanks very much. My name is Greg Marshall, and I'm the State Director at AARP Vermont. And on behalf of our 112,000 members, I want to thank you for the opportunity to testify in strong support of the VT Saves retirement program. Most of you know we're a nonprofit, nonpartisan organization dedicated to empowering Americans 50 and over to choose how they live as they age. And in doing so, we support policies that enable Americans nearing or currently in retirement, as well as those who will retire in the future, to become financially secure. Saving for retirement is simply one of the most important things you can do for your future. And VT Saves offers an easy way for employees without access to a workplace plan to grow their savings that they need for a secure retirement. Americans are 15 times more likely to put money away for retirement if they have a savings account at work. Yet 40% of Vermont private sector employees work for businesses that do not offer a workplace plan, leaving about 88,000 Vermonters behind. This gap continues to grow, and this growing crisis of Vermonters who lack sufficient savings for retirement and for emergency spending when they need it. Vermonters' lack of savings is a crisis across the board, yet racial disparities are still quite striking here. In Vermont, Black workers are half as likely to be covered by workplace retirement plan than their white counterparts. And to reduce wealth gaps and barriers to economic mobility, we need programs like VT Saves, and we need them now. While Social Security is a critical piece to the retirement puzzle, it alone is not enough to provide a strong financial future. The average Social Security benefit for people 65 plus in Vermont is only about $21,000 per year, even though these families spent almost about $33,000 a year on the basic necessities, things like food, utilities, and healthcare. BT Saves will lead to greater economic security for Vermonters as they age, relieving pressure on the social safety net programs and family members who would otherwise fill this gap. As the treasurer noted, 16 other states have adopted legislation that helps employees save their own money for retirement as they work. And we urge Vermont to join them by passing and implementing BT Saves. And if passed, I think also as the treasurer suggested, AARP Vermont is committed to working with the treasurer's office and other stakeholders to support a strong and robust public education and engagement plan to make sure that BT Saves maximizes all the impact it can for folks that need this program. Just one final thing, at AARP, we consider a strong retirement as sort of a four-legged stool. That stool includes a strong Social Security. That one of the four legs is a strong Social Security program. The other is a strong Medicare program. And the other stool is personal savings. So that's what people can put aside a little bit each month, and then some kind of a workplace plan. Those four pieces together are what helps ensure, particularly for low and moderate income workers, an ability to create for themselves a strong financial backing when they get to retirement. When we start to remove one of those legs and make it a three-legged stool or even a two or a one, we're talking about very significant problems as far as retirement savings and the ability to meet what people need to pay for in their daily needs. And again, those are things like rent, food, prescription drug costs, those sorts of things. I want to thank the chair and the committee for allowing me to testify today, and I'd be happy to take any questions if there are any.
Thank you, Greg. Any questions, committee? Thank you very much.
I appreciate your time. Thank you.
Thank you.
Thanks.
We appreciate your support of this too.
Thanks very much.
So committee, I think, one recommendation I think we should make is, just adding appropriations and ways and means and finance to this. But is there anything else you see that, maybe in the report? Is the report sufficient? I think it could include, number of participants, the investment options, rates, returns, projected activities. Is there anything else you see that?
My concerns were satisfied by Mike's answers, Mr. Chair.
I think there's a lot that's going to be done in rulemaking.
Yeah.
Given the treasurer's former role, I think he's well aware of things that we'd be looking for. There maybe go beyond what is here. Okay, so I think the only thing that we recommend is just adding a couple more committees on there for the report. Everything else, I think, is pretty good, and we look forward to the rollout of it. Okay. Excellent. Thank you all for joining us.
Thank you.
Thanks very much.
Thank you.
So I think it's spring time. We'll be back at 11 on the auto franchise law. Also, Andrew has given us the sheet, the parking permit at UVM. We should leave here no later than 3. Get there for 45. It starts at 4 and concludes at reception line at 5:30. So an hour and a half. There'll be a little chit chat after the reception as well. So